Welcome to the Deep Dive. We're digging into Cango Inc's Q2 2025 earnings report today. Lots to unpack here. It looks like a company really reinventing itself.
Absolutely. It's more than just the numbers this time. Cango's painting this picture of a pretty dramatic transformation. We'll get into the financials, the big strategic moves, and, what it might mean going forward.
Sounds good. So let's kick things off with the headlines. The numbers themselves tell quite a story. For Q2 2025, total revenue was around $140 million?
Yeah, just under. About $139.8 million. And what's really striking is 99% of that, roughly $138.1 million, was straight from Bitcoin mining.
Wow. And production.
Impressive. They mined 1,404.4 Bitcoin in the quarter.
Okay, but the profitability figures seemed a bit mixed.
That's where it gets interesting, yeah. They reported a big GAAP net loss, about $295.4 million.
Oof.
Right? But you got to look closer. That loss was mostly driven by non-recurring, non-cash charges, things like depreciation, impairment from acquisitions, stuff like that.
Okay. Accounting noise.
Exactly, because if you look at their adjusted EBITDA, which is, a better measure of actual cash flow from operations that soared, it hit $99.1 million.
Big difference. So the underlying business is generating solid cash.
That's the signal, yeah. It suggests investors, the sophisticated ones anyway, are looking past those one-off charges to the core operational strength.
And the market reaction seemed to reflect that. Stock moved up after the call.
It did. Saw a notable jump. It really indicates confidence in the strategy and the operations, despite that headline loss figure.
Right. Investors focusing on the momentum, not the accounting adjustments.
Precisely. They seem to be looking at the bigger picture, the strategic direction.
Okay, so let's really unpack this transformation, because it feels like Cango just did a complete 180, right?
Pretty much. This Q2 was their first full quarter operating under this new model. Over the last 9 months or so, they completely sold off their old China assets.
Right, the clean exit from China, as they called it. For how much?
Pulled in $352 million from that. And they didn't just sit on the cash, they immediately redeployed it into building out their global Bitcoin mining operations.
And that got them to 50 exahash.
50 exahash per second, yeah. Which is huge. To put that in perspective, that's roughly 6% of the entire global Bitcoin network's hash rate as of the end of June. Puts them right up there with the biggest players.
So that rapid scaling is directly showing up in production now.
Absolutely. You saw in July, their first full month with the 50 EHs running, Bitcoin production jumped to 650.5 BTC.
Which is a 44% increase from June?
44.4%, yeah. Direct result of having all that capacity online and working.
So how are they managing this scale up so fast? What's the secret sauce?
Well, management keeps emphasizing their asset-light model. The idea is they acquire these plug-and-play mining rigs, which means less upfront capital needed compared to, say, building everything from scratch.
Faster deployment, lower initial cost?
That's the theory. And potentially lower depreciation hitting the books later, which helps that all-in cost metric we'll talk about.
Okay, but wait. Asset light. Then they go and buy a whole mining facility in Georgia. That sounds pretty asset heavy to me. How does that fit?
Yeah, that's a really good question, and it's kind of crucial to understanding their nuance here. So they bought this 50 megawatt facility in Georgia for about $19.5 million.
Okay.
30 megawatts are for their own mining, 20 megawatts they'll use for hosting other miners. But see, this isn't really about ditching the asset light idea for rigs. It's more strategic vertical integration. Meaning it's about getting control over their power costs and the stability of their operations. At this scale, energy is everything. Owning the site gives them direct control management experience.
So it's controlling the infrastructure to optimize the performance of their asset-light rig.
Exactly. It's tactical. It gives them a stable base, a model for potentially lower power costs, and a platform for future upgrades. It's less about owning buildings and more about controlling the energy equation.
Got it. That makes more sense. So, speaking of costs, what is their cost to mine a Bitcoin now? That's always the key metric, especially with, hash rate climbing globally.
Right, critical point. So in Q2, their average cash cost was $83,091 per Bitcoin. The all-in cost, which includes depreciation and other non-cash stuff, was $98,636.
The cash cost seems a bit high compared to some others.
It might appear that way, yeah. But management argues that the asset-light model helps keep the all-in cost competitive because depreciation is lower, offsetting some of those higher power expenses they might face with hosting partners.
So it's a trade-off.
It seems so. They definitely acknowledge the headwinds, rising global hash rate, power costs going up, but they believe their strategy, combining owned sites like Georgia with efficiency upgrades, is the way to mitigate that.
Okay, so managing the present. What about the future? Did they lay out a clear roadmap?
Oh yeah, very clear. Three-phase plan. Near term, the focus is all on optimizing the 50 exahash they already have.
Fine-tune.
Right. Efficiency upgrades, trying to replicate the low-cost model they're aiming for in Georgia,
Yeah.
and maybe selectively acquiring more sites like that if they can get good power deals.
Makes sense. What's phase 2, the medium term?
That's where it gets more ambitious. They're planning to pilot new renewable energy storage projects. The goal, aiming for near-zero cost mining. Big goal.
Wow. Okay. Anything else medium term?
Yes, and this is key. They plan to start retrofitting some facilities to support high-performance computing or HPC applications.
So moving beyond just Bitcoin mining.
Exactly. Which leads into the long-term vision,
Which is
building what they call a dynamic computing platform. Think of it as a flexible system that can intelligently switch between mining Bitcoin and running AI or other HPC workloads, depending on what's more profitable.
so arbitraging compute demand, leveraging their energy expertise.
Precisely. It positions them to capture value from the AI boom while hedging against Bitcoin mining volatility. It's a move towards becoming a broader digital infrastructure player. That's the long-term value proposition they're pitching.
And it sounds like analysts are definitely paying attention. We saw questions on the call from Goldman, Citic, Greenridge, H.C. Wainwright, all pressing on these points, right?
Yeah.
CapEx, green energy, market share.
For sure. The Q&A was insightful. On market share, management said they're focused on deep optimization, meaning getting more efficient with the power they have, phasing out older miners, upgrading, while still keeping M&A on the table.
And they doubled down on asset light,
Yeah.
even with Georgia.
Yeah, they clarified that site acquisitions are about strategic control and flexibility, not abandoning the core asset-light principle for the mining hardware itself.
What about regulatory risks, especially with a bigger U.S. footprint now?
They touched on that.
Yeah.
Said they're monitoring policy closely, have local compliance teams engaging with regulators. Interestingly, they noted most states where they operate are actually supportive of this kind of infrastructure investment. Some hurdles for converting crypto power to general compute in certain places, but they seem confident in navigating it.
Okay. And finally, shareholder returns. Management thinks the stock's undervalued,
They do.
but they're prioritizing growth spending right now.
That's the balance they're striking. They mentioned commitment to returns, and they have an ongoing share repurchase program. But yeah, the primary focus right now is deploying cash into high-return operational expansion and transformation. That includes investing in those new high-value areas like ADC AI data centers.
Growth first, basically.
Which seems to be the message for now. Build the platform, capture the opportunity, and value should follow.
And just a quick housekeeping note for listeners. Cango's switching its reporting currency. No more RMB.
Right. Starting next quarter, Q3 2025, everything will be in US dollars. Should make things a bit easier for comparison.
So let's circle back to the investor view. Why do you think the market reacted so positively to this quarter, given that big GAAP loss?
Well, I think it boils down to a few things. That strong adjusted EBITDA number really stood out, showing the cash-generating power. Then there's the rapid, successful scaling to 50 exahash. They delivered on that promise. Execution, exactly. And finally, that forward-looking roadmap. The energy control strategy, the pivot towards HPC and AI. It offers a compelling story beyond just pure mining. Investors seem to be buying into that future vision and looking past the short-term accounting noise.
And how does this fit into the wider Bitcoin mining industry right now? What's the context?
The whole sector's facing pretty stiff headwinds, Global hash rate keeps climbing, power costs are a constant battle. It really puts the squeeze on miners.
Making scale and efficiency paramount.
Absolutely critical. So Cango's strategy controlling power costs with own sites aiming for efficiency. And building that HPC optionality, it looks like a smart way to build resilience and potentially outperform in a tough market. It gives them levers to pull that pure miners might not have.
So looking ahead, what are the key things you'll be watching for from Cango? What are the catalysts?
Okay, definitely the Q3 earnings, the first one's in USD. Keep an eye on updates from the Georgia site, specifically power costs and efficiency metrics. Any news on more site acquisitions or power agreements would be significant.
And the production numbers, presumably.
Oh yeah, the monthly Bitcoin production figures are always important. And critically, any traction on the HPC front pilot projects, maybe landing an actual customer, that would be a huge validation point.
And of course, the usual suspects.
Right. Bitcoin price swings, overall network hash rate changes, those macro factors will always play a big role for any miner stock. Lots to track.
All right, perfect time to transition to our This Is Not Financial Advice segment. We take what we've learned and spin out a, let's call it an outrageous but plausible trade idea. Remember, purely informational, just a thought experiment.
Okay, let's get creative. So you've got Cango making this incredibly aggressive pivot. You had that big non-cash charge muddying the Q2 waters. And then there's this ambitious long-term vision blending Bitcoin mining with AI and HPC. It's a lot.
Definitely a dynamic situation. So given management's talk about investing in AI data centers, that HPC roadmap, and their view that the stock's undervalued despite the recent bump, what's the outrageous play?
How about this? A long straddle, but paired with a small, longer-dated call spread.
Okay, break that down. Long straddle first.
Right. A long straddle basically bets on big volatility. You buy both a call and a put option at the same strike price in expiration. You profit if the stock makes a significant move, up or down. You don't have to guess the direction, just that it's going to move substantially.
And that fits Cango because...
Because they have this dual identity now, right? They're still tied to Bitcoin's crazy volatility, but they're also trying to execute this complex multi-year tech pivot into HPC AI. That creates potential for big swings. Either way, success or failure in the pivot or just crypto market madness.
Okay, so the straddle covers the inherent volatility. What about the extra call spread?
That's the targeted high upside kicker. It would be a relatively cheap bet specifically on the success of the HPC AI pivot if they actually pull it off, announce a major AI deal, or show real HPC revenue in the next, say, 12, 18 months.
The stock could get re-rated way beyond typical Bitcoin miner multiples.
Exactly. So the call spread is a cheap way to capture that potential massive upside if the AI dream becomes reality. The outrageous part is making this dual bet hedging broad volatility while simultaneously making a specific long shot bet on a successful tech transformation. It's a gamble on management navigating two really tricky high-growth sectors at once.
An asymmetric bet on a very ambitious strategy. I like it. Definitely outrageous, maybe plausible.
So as you think about Cango, maybe the final thought is this. Are they just reacting defensively to the tough crypto mining market, or are they genuinely building something new and more resilient here? A flexible computing powerhouse that the market hasn't quite figured out how to value yet?
It's a lot to consider there. Well, that wraps up our deep dive into Cango Inc's Q2 earnings. Thanks for joining us.
Hope this breakdown gives you a clearer picture of their complex journey.
Remember, everything discussed today is for informational purposes only. It's not financial advice. Always do your own research. We'll catch you on the next deep dive.